Hello, and welcome to Trestlebridge Capital's monthly market and economic recap. Before we begin, here's a quick note from our legal team. Today's discussion is hosted by Eric Jefferson, managing partner of Trestlebridge Capital, as he breaks down this month's key market updates. Let's get started.
Hello and welcome to the Trestlebridge Capital Market and Economic Recap for May 2025. A lot to discuss, so let's start with a quick summary of capital markets. The S&P 500 in May, positive about 6%, and that now brings it marginally positive for the year. Once again, led by technology, one of the hardest hit sectors in early April that has made a very sharp and swift recovery. NVIDIA, world's largest chip maker, reported earnings last week. Once again, managed to absolutely smash expectations. That was even with a very large write-down in chips that were originally headed for China, but halted for national security reasons. For more moderate and conservative investors, we saw bonds trade virtually flat on the month, as was gold. Gold being one of our favorite tactical plays. A year-to-date that's still positive, plus 25%. With our preferred exposure owning gold mining companies, up about 60%. Turning to the headlines, U.S. Court of International Trade ruled unfavorably with respect to the legality of the Liberation Day tariffs. That was immediately appealed. Likely won't have a resolution there for some time. I would not be surprised if that ultimately made its way up to the Supreme Court. Immediate response, though, was bullish for stocks. Long term, really don't think that changes the outlook. I think we're starting to see both investors and businesses alike accept the fact and start to get comfortable with the notion that tariffs, certainly wherever they land, will be higher than where they were when they begin the year. That being said, you're really starting to see companies get comfortable with the fact that they're able to adapt and evolve in whatever that new tariff regime will be. One point I do want to clarify with respect to tariffs. So those apply to the cost of imported goods. Let's say, for example, you have a sweater that retails for $100. If that is produced entirely overseas, ready for distribution and retail once it arrives, let's say tariffs were 10%, the effective rate depending upon where that was imported from, you would see that full $10 reflected in the new price. That $100 sweater would now cost $110. However, if you think about goods that are assembled within the U.S., so take a washing machine, for example, not that you can buy one for $100, but let's say hypothetically that only $40 of that washing machine covered the cost of the imported materials. The other 60% was a function of it being assembled and then distributed. That same 10% tariff would only apply to that $40 of the cost of goods being imported. As a result, in that same tariff policy, that washing machine would now retail for $104 as opposed to the $110. So one clarifying point here when you think about what that impact tariffs will have, it's not that it's a blanket cost on every single good. The other thing to keep in mind, where the US dollar has depreciated but roughly about 8% from the all-time highs in February, that now in many ways helps offset some of that higher cost of tariff. So we think long-term what those implications are. Obviously, at the end of the day, it is a function of where those tariff policies ultimately land. But I think for many, hopefully this offers some assurance that the worst case scenario of all goods immediately increasing 20, 30, 50% is much less likely. Turning to the bond market, we saw the credit rating of the U.S. government be downgraded by Moody's. They're one of the big three credit rating agencies. That downgrade, they cited the unsustainable trajectory in government spending. Don't think that should have caught anybody off guard. Certainly that has been a trend in place for decades within the United States. Unfortunately, don't see anything on the immediate horizon to meaningfully alter that trajectory. Not surprisingly, Mark was able to brush off that downgrade with very little disruption. On the economic front, inflation data continues its modest decline. PCE data came in at 2.5. Again, it's still above that Fed target of 2%, but every month we inch closer and closer. Obviously, that does give the Federal Reserve more flexibility. If we did see a material softening in the hard data, that would then result them to cut interest rates. Finally, on a separate note, for any golf enthusiasts, the ticket window for the 2026 Masters Tournament is now open. That closes on June 20th. This is your opportunity. Submit your name. All tickets are offered or made available through their lottery system. That is going to be at a much, much lower cost than buying them on the open market, subject to some very significant markups. That's all for this week. As always, want to thank you again for taking the time to join us. Please don't hesitate to reach out with any questions.